Okay, good morning everyone, and welcome to our property tax webinar. Thursday definitely feels like a much brighter day than Monday did, well certainly for me. I'm sure all of our Italian guests, those that have joined today, have had a great week, so congratulations to them. The housing market, obviously we're talking about property today, and as you all know, it's been booming throughout the coronavirus pandemic. And as many homeowners have moved from cities seeking homes with green space and fueled by the so-called stamp duty holiday, we've really seen a frenzy in the market. But obviously that holiday, all holidays come to an end, and we're slowly starting to see the easing off of those reliefs. And I think I read an article yesterday saying that the number of sales in July are running at approximately 50% of what they had been in the previous few months. So that might be just a hangover from the frenzied activity over the past year, but and a blip, but something to sort of keep in mind. We know our housing market in the UK is a very buoyant market from time to time, and well, let's see how it goes on. But anyway, joining me today is with extensive knowledge and experience, of course, in tax and property, are Salish, who many of you will know is a director and also one of the founding partners of McAlvin's. And also with us is Phil Stevens, who has been on a number of these webinars also, and heads up our tax department. So welcome both Salish and Phil. As I said, they're going to take us through a roller coaster ride on everything to do with property and taxes. We plan to cover most big things, but obviously we're restricted by time. If there is anything that you feel we've missed, then please raise it in the Q&A box, which is somewhere on your device, and we'll either try to address it on the fly or alternatively at the end of the webinar. And if we don't have any time at the end, then please do feel free to reach out to either your client director or Salish, Phil, or myself, and then we'll help you where we can. With that said, I now hand over to Salish. Thank you, Salish.
Morning, everybody. We'll kick off on the slides. Investing in property appeals to many people. I think buy-to-lets has been a buzzword for the last 10, 15 years. And people have seen investing in property as, or many people, as a mainstay as part of their capital appreciation and retirement plans. From experience, I would say rental yields, whilst headline rental yields are always seemingly better than bank deposits, I think by the time you take into account property management, repairs, etc. there, and tax, of course, and the yields, in my view, aren't that great. But it is the long-term capital appreciation that people are really focusing in on, in my view. And also the ability that you can get bank borrowings and leverage your investment. And with a market that's always increasing, it always seems to end up with giving you quite a decent return. However, as a property investor, you need to know that there are many potential tax pitfalls. The tax landscape has become more and more complex, and each year there are new rules being introduced and waiting to trip up the unwary. The good news is that there are also many useful tax reliefs as well, and we need to make sure that we take advantage of where we can. Structure. We get a lot of questions when people want to invest in properties. What structure should I use? Should I use a trust? Should I own it in a personal capacity? Should I buy it with my wife? Should I form a investment venture with a friend, limited company, limited liability partnership? You can even use your pension scheme for commercial property acquisitions. So there are many structures to consider. There's no one simple answer. A structure really needs to be tailored to your individual circumstances, your objectives, your long-term objectives, why are you investing in property, will you be disposing of in the short term, medium term, long term. It's endless. Everybody has a kind of a different outlook, and we need to consider each and every one of these to come to a suggestion for you. Usually, personal or joint ownership will be the most suitable structure for smaller investors. For example, claims to renter room relief, capital gains tax, private residence exemption, furnished holiday let status will generally only be available for personal owners. Trusts may be appropriate in some cases, particularly as part of an inheritance tax planning strategy linked to family asset protection, but they can be complex and relatively expensive to run. Limited companies may suit some investors as profits are subject to corporation tax and a maximum rate of 19%. However, the corporation tax rate is set to increase for some businesses up to 25% from April 2023. Another problem with limited companies is that there is a potential double tax charge. One is that you pay corporation tax when you sell the property within the company, and then when you wish to extract the funds from the company, there's a further tax charge, which could be a dividend tax charge or a capital gains tax charge again. So again, if you're investing in property with a view to selling it in the next 3-5 years, maybe a limited company isn't the right solution for you. A company will probably only be the right choice for larger investors who are planning to hold property ownership for long term for the benefit of future generations of families. i.e., if you're not going to be selling the property, then you avoid the double taxation. A limited liability partnership, or LLP, is a corporate entity, very much like a limited company for legal purposes, can also be used in similar ways, which has some benefits of owning property individually, but also has some benefits of corporate ownership. Pension schemes can be a very tax efficient way to invest in commercial property, including premises used by members' businesses. As well as providing a source of funding, the pension scheme's tax-exempt status allows the rent paid to it by the business to accumulate tax-free, and any profits on the eventual sale of the property can be tax-free too. So, in conclusion, in choosing a structure, it is important to consider the commercial picture as well as the tax implications. For example, the cost of running a company or a trust and the cost of borrowing. So there's plenty in the mix that all needs to be considered before we arrive at a conclusion of what is the most appropriate structure for you.
I think moving on to rental income and how that's taxed.
Yeah, so the amount on which tax is charged is obviously the net rental income for each tax year, i.e. for the tax year ending on the 5th of April. Net income consists of gross rent attributable to the tax year in question, less property-related expenditure, and where appropriate, less capital allowances. An individual taxpayer, including partnerships, are required to use the simplified cash basis, i.e. the actual dates of receipt and payment, if gross rental income is below £150,000 and no election is made to use the accruals basis. Other structures, for example, companies, are required to use the accruals basis, and that is effectively to account for rental income under generally accepted accountancy principles, i.e. on an invoice basis or a rent receivable basis. If rent charged under the accruals basis overlaps the tax year, then you time apportion it for the rent that falls within the tax year. So, for example, if a letting commences 1st of October 2019 at £12,000 per annum, the amount assessable under the accruals basis in 1920 tax year would be £6,000, i.e. 6 months. However, if all that £12,000 was received in the year and you were accounting on a simplified cash basis, then 12,000 would be full to be taxed in that tax year. If a property is jointly owned, then the net income is then split in the relevant proportions and assessed separately on each individual at the appropriate tax rate after taking into account any allowances or losses which may be due. For each tax year, personal taxpayers, half of the expected tax liability normally be due on account on 31st January and 31st of July, with any balance due payable the following 31st January. So let me give you an example on that. For 2020, for the tax year 2020-2021, payments on account which are based on the previous year's income would be due on 31st January 2020, i.e. half then, half on 31st July 2021, and the balance payable on 31st January 2022. For companies, tax is payable in full 9 months after the year end, so a very different way that rental income is taxed and paid. Moving on to losses. So rental losses. If you have more than one property, if more than one property is let, a loss for a year on one property can be set against a profit on another or against profits from a UK furnished holiday lettings business. Unrelieved losses can be carried forward and set against future profits of the same property business. So if you made a loss of £10,000, you had two properties, you made an overall loss of £10,000, you would not pay tax this current year. For the following year, if you made a rental profit of £15,000, you could bring forward the £10,000 unrelieved and just pay tax on the £5,000. An overall loss cannot, however, be set against income from other sources, such as employment or investment income. So again, if you have a rental loss of £5,000 and you had employment income or investment income of £20,000, you can't offset that £5,000 against that 20 in that taxed year. There is one exception to that, but that is where you have excess capital allowances which are attributable to the loss, and an election is made to account for rental income and at the accruals basis. But this can only apply where the rental income is arising on commercial properties, as there are no capital allowances available on residential investment property investments. If a taxpayer receives rental income in another legal capacity, for example, you're a partner in a partnership, then this is a separate property business. UK property losses arising in a partnership cannot be offset against UK property business profits arising to a partner as an individual. So again, the example here is you may have a buy-to-let property in your individual capacity, and you also may be in a property partnership with two friends. So a loss in one cannot be offset in another. The loss has to be offset in the same property business. So broadly, with those rules, any losses not utilised at the time when property letting ceases or the property business ceases will normally remain unrelieved. Pre-letting expenses before a property is let on commercial terms, or expenses incurred in periods between letting on commercial terms, is normally deductible from future rents. So where a person buys a property, gets it ready for rental, there will be an element of that expenditure which will be relievable against future profits. Where property is occupied rent-free or at a low rent, perhaps by a relative, generally speaking, you cannot claim a loss. You may not pay tax on any rental profits if the expenses match the rental income, but any excess expenses will generally not be relievable. Rules for companies are very different. Generally speaking, losses can be offset against other income arising in the company, and if unrelieved, carried forward or group relieved. So it's very different. And you should also be aware there are caps on losses. There are anti-avoidance rules on how much tax loss you can claim, which also needs to be considered. Moving on to mortgage interest relief. So,
question for you, Salish. Sorry to interrupt. A quick question for you. So on pre-letting expenses, I presume this relates to sort of repairs as opposed to significant upgrades, which would be more a capital item, right?
Yeah, but even repairs, so it really does depend the state of your properties. If you buy a fairly rundown property and you bring it, you have to spend monies to bring it up to standard to be able to let, then a large part of that will be capital expenditure. I think Phil could mostly answer that better.
Yeah, you're right. If it's a significant upgrade or a significant enhancement to bring the property up to a state that you can rent it, it would be capital. But you know, I guess going in and pre-letting expenditure, you know, maybe replacing one or two items, you know, decorating, etc., would normally be relievable.
Okay, yeah, I thought it was worth asking that question. I didn't have it come up, but I suspect it's one that people will be thinking about. Great, cheers, thanks for that. So I think we're moving on to mortgage interest relief, Salish.
Yes, so again, a quite topical category, mortgage interest relief, because the government changed the rules in April 2017, and that sparked a lot of talk about incorporating property portfolios into limited companies, because limited companies still get full interest tax relief. However, there are many issues on property incorporation which we're not covering today, but the main point is, can you incorporate your property portfolio without any tax arising? And secondly, we also talked about having the most appropriate structure. You know, mortgage interest relief is just one factor. There are many other factors to take into account. But generally speaking, interest on a mortgage or other loan incurred for property letting is an allowable deduction for tax purposes. The loan doesn't need to be matched with a particular property. So if several properties are let, the interest on a loan from a property that has been sold will still be deductible, provided other properties continue to be let. Interest may sometimes be deductible on loans used for other purposes. In particular, interest on any loan up to the value of the property when it was first let will be allowable. As I said before, though, from April 2017, new rules were introduced. Prior to that, the interest relief was given in full. But from April 2017, the relief that is now given is restricted on how much loan interest you can get back. Under these rules, all financing costs incurred by an unincorporated landlord is now given as a basic rate tax deduction of 20%. So even if you're a higher rate taxpayer at 40% or higher, you can only get relief at 20%. Those landlords that incorporate their portfolio into a limited company can benefit from interest relief as per the original rules, and in essence, that's full relief. Renter room scheme. This relief was introduced a while ago, and it's basically, broadly speaking, it's where applies where you take in a lodger. So basically, any income that arises from the letting of furnished accommodation, which is part of your main residence, is exempt from tax, provided the rent is less than or does not exceed £7,500 in the tax year. If the house is owned by you and your wife, then obviously the limit is reduced to 3,750 each. Obviously, it doesn't mean your wife, but it could be joint ownership. So the limits are reduced accordingly. As I said, the property must be used as a main residence at some point in the relevant period for the exemption to apply. If the gross rent does exceed £7,500 in a tax year, you can either elect to be assessed on the amount by which the gross rent exceeds £7,500. So, for example, if the rent is £10,000, you can be taxed. You can elect to be taxed on £2,500, or you prepare a rental statement where you basically draw up all a statement of income, less expenses, and you assess yourself to net income in the normal manner. If expenses exceed income, you can elect for the exemption not to apply so that tax relief can be obtained for the loss. As I said, rental room relief only applies to residential properties and not commercial properties. Obviously, a commercial property is unlikely to be your main residence. Can we move on to slide 7? Replacement of domestic items relief. So prior to April 2016, we had a system which was called a wear and tear allowance. And generally speaking, where you rented out furnished lettings accommodation, you were eligible for a flat 10% relief, wear and tear relief, 10% of your rental income. So if you had rental income of £10,000, you would just be given a relief of £1,000 as wear and tear allowance. This has now changed from April 2016. So landlords of fully, partly or unfurnished residential property can claim for the actual cost of replacing furnishings. This is the replacement of domestic items relief. It does require more record keeping than when the flat rate deduction for wear and tear was available, obviously. This relief is not available to furnished holiday let businesses. Items which are available for this domestic items relief include movable items of furnishings such as bed frames, tables, sofas, televisions, fridge, freezers, washing machines, carpets, rugs, curtains, linens, crockery or cutlery, and other general furniture. You have to draw a distinction between those type of items and fixtures. Fixtures are part of a building which would not normally be removed if you sold the building, and these fixtures do not qualify for domestic items relief. So examples of fixtures would be baths, wash basins, toilets, boilers, fitted kitchen units. So in essence, if you had to replace a toilet or a bath because it was cracked, you would not be eligible for domestic items relief. The amount of a relief only applies to replacement costs. So the initial cost of furnishing a property is not included, i.e. you can't claim this against rental profits. So for example, if you buy a property, the question was asked, and you have to install a fridge, can you claim it against rental profits? The answer is no. It's only when the fridge unfortunately needs replacing. The other thing that you need to watch out for is that any improvement cost is excluded from this domestic items relief allowance. So for example, if a washing machine is replaced by a washer dryer, then the relief is restricted to a similar replacement cost of a washing machine that is similar to what you had in the first place. So any improvement, either technologically or whatever, generally speaking, you can't claim it.
Okay, you reminded me of something. I lived in Italy for a couple of years and in a rental property, and it's quite common in Italy when you rent a property that doesn't even have a kitchen in it. The fittings of the kitchen are not there. You literally bring your own kitchen from wherever you lived before, and there's normally hooks there, and it just sort of hooks into place, and other items as well, which, you know, we won't go into detail here, but there's the stark difference between the UK and Italy, not because we had a game at the weekend, but bringing that up, but you don't get a kitchen in Italy if you're in a property. Furnished holiday lettings, Salish.
Furnished holiday lets, yeah. Furnished holiday lets are taxed, are properties which are basically let out on short-term lets as opposed to an AST. The definition is much more complex than that, but that's broadly what we're talking about here. Furnished holiday lettings actually attract various tax reliefs over and above what a normal buy-to-let property or commercial properties have. But if you do have to certify, you do have to satisfy certain conditions if rental income, the expenditure and capital expenditure are to be treated as falling within the furnished holiday letting rules. So first and foremost, the property must be furnished accommodation and let on a commercial basis with a view to making a profit. Under the furnished holiday letting rules, landlords are treated as though their qualifying business is a trade. And this then entitles them to claim capital allowances along with certain other capital gains tax reliefs, including business asset rollover relief and business asset disposal relief. So why this is important is that business asset rollover relief allows, if you sell a property, a furnished holiday lettings property at a gain, the tax can be, the capital gains tax can be deferred if you reinvest the proceeds into another qualifying asset, which could be a furnished holiday lettings property. So i.e. you don't pay any tax, you keep rolling over the tax. Business asset disposal relief, which was formerly the entrepreneur's relief, which you would also be eligible for, reduces the capital gains tax potentially payable on the disposal of a property down to 10%. That's comparable to the capital gains tax rate on residential property of 28%. So it's quite a saving. It's nearly a saving from 28% to 10%, which is quite large. So these are quite big advantages. Furnished holiday letting income, i.e. the net rental profit, is also treated as part of your net relevant earnings, where when calculating tax relief on an individual's pension contributions. So, you know, that income can be then used to enhance of how much you could potentially contribute to a pension and get tax relief. Furnished holiday lettings, as with any other property businesses, also has the potential to be eligible for inheritance tax business property relief, although claims are often unsuccessful as the burden of proof of getting this relief is quite high. Why this is quite important is that many people within their estate have property, and on death, then this is subject to 40% inheritance tax. If you have a furnished holiday letting, which you can show is a trade, then you will get 100% exemption from inheritance tax. However, to show that you are operating your furnished holiday letting as a trade, there is quite a high burden of proof, and you have to show real activity and real involvement, time involvement, to show that you are actually treating this as a trade. And obviously, the more properties that you have, the easier it becomes. But if you have one or two, it does become quite difficult. But you can see that under this whole category of furnished holiday lettings, whilst there is more management because there are more short-time lets, the taxation of these properties is much more advantageous compared to just investing in properties as the norm. But the rules and the conditions to be met are a little bit more stringent as well.
Thank you, Salish. We've got a question coming from Simon, but I think I'll hold it until the end when we get through the other slides. So I think we're on to principal private residence now. Yeah.
So principal private residence relief is a huge relief, and I think most people are knowledgeable of it. However, it is not always so straightforward. There are a huge number of conditions that you need to qualify, and most people just assume that because I lived in this property, it's eligible for relief. Generally speaking, when a person sells their main residence, no capital gains tax is due, as the gain is covered by the principal private residence relief. But what is the definition of a residence? A residence obviously is a place where one lives. However, where an individual has more than one residence and a nomination is not made, it could affect which property is eligible for the relief. So if you have a house which you live in Monday to Friday, weekend you go down to the Cotswolds, if you're lucky enough, then you've obviously got two properties. If you haven't nominated which one is your principal private residence, then it could give you a tax bill larger than you expected. HMRC, where you have two properties, will consider which property is eligible for principal private residence relief. They will not automatically accept that the main residence is where the individual spends the majority of the time. They will take a holistic overall look and look at things like where the address for your utility and other bills, which address you use as your voting register, which address you use as your bank, etc., etc. So it is not that always so straightforward. And where you have two properties, it is important to kind of have a look at the circumstances and ensure that you plan your affairs correctly. If your property has more than one building, for example, outbuildings, are the outbuildings included in the relief and within the definition of a dwelling house? Well, that will depend on the relationship of the outbuildings to the main property and whether they can be considered as a single entity. I think there's also where you have large gardens. People sometimes have large gardens and sell parts of that garden for another housing development or another residence to be built. When you sell that garden, is it covered by principal private residence relief? Again, it depends. It depends on whether that garden is relatively, or is required relative to the size of the house. And again, you have to look at it holistically. You are entitled to principal private residence relief on a disposal of a property to the extent that it was your only or main residence during the period of ownership and that there has been some period of occupation of the property. If the property was not your only or main residence for the entire period of ownership, then you have to apportion the gain between periods when it did qualify as your principal private residence relief and when it did not qualify for as your residence. There are certain periods of absence which do qualify as relief. For example, the last 9 months of ownership prior to 2020 was the last 18 months of ownership, and there are other periods which qualify under certain conditions as well. But you can see the relief isn't always so straightforward, and again, it's just something you should consider where you have more than two properties, or you have outbuildings or large gardens in which you're looking to sell, or you've been absent at all from occupation.
Great. Thanks, Eilish. Phil, that's going to take us through capital gains tax. I think we've got quite a few slides to get through, so I think this is the down slide of the roller coaster. So over to you.
Yeah, all the good stuff's gone. This is all the horrible stuff that comes into bite without people realizing. Okay, good morning, everyone. So the first slide we're looking at is capital gains tax, and following on from Sailesh's notes and comments on sort of PPR and things like that. There are new rules that have been introduced if you are or have not been resident in the UK for tax purposes that restrict the ability to claim the main residence exemption. If you do not benefit from the main residence exemption, i.e. you're a non-resident who's not able to claim, or it's a disposal of a second property, we now have rules that say capital gains tax is payable within 30 calendar days of completion of the sale. And this obviously occurs where a property has been let and sold at a profit. A capital gains tax return would need to be submitted to HMRC within those 30 calendar days of completion of the property. A failure to complete a return and pay the tax within the 30 days of the sale of the property will incur a late filing penalty and interest. There is talk at the moment of extending this to 60 days because I think the solicitors who have been helping, obviously when conveyancing is going ahead, and tax advisors have advised that it's 30 days isn't necessarily a doable time frame, but at the moment that's what we have, and the 60 days is just up for discussion. Capital gains tax will be due where property is sold more than 9 months after it was last used as a main residence. So as Salish mentioned, this 9-month period, if you end up in a chain and you sell your property 18 months, 2 years down the line, you would have to consider whether or not there is this element of an apportionment between main residence relief and non-qualifying periods. Where a chargeable gain arises on a property which has been a private residence and has also been let at some point, private letting relief of up to £40,000 per owner may be available. Lettings relief was generally available if it had been your main residence at some point, but the rules were tightened up from April 2020. And therefore, lettings relief now is only available if it is still your main residence during the period of letting. So what we had before was somebody who would have a house, move out into something else, let the previous main residence out and would get lettings relief. Now you have to actually physically occupy it as well. So it's a slight tightening of the availability. It may be possible to reduce CGT by transferring part of an interest in a property to a spouse or civil partner to maximise the use of annual exemptions and lower rate tax bands. For spouses, the default position, regardless of ownership of the property, is 50-50. So if you own it 95/5, for instance, the revenue will take the default position to be equal. And then election needs to be made to HMRC to demonstrate the spouses have different beneficial ownerships. Obviously, if it's a non-spousal relationship, that those elections can be made at the start. And a property is still subject to CGT if owned by a non-resident individual or entity, and that's something I will come on to a little later on.
Quick question: if you feel it's not capital gains tax, but it's linked to the deemed sort of shared ownership, I suppose, that you were referencing before, between spouses, 50-50. Is that true for rental income as well, and taxation of rental income?
Yeah, so if you own it 95/5, for instance, the default position is the income is taxed 50-50 between spouses. The same with the capital gains tax. You have to really inform the revenue that the beneficial ownership is different to the actual their default position. There's a form called a Form 17, which you send to them to say this is the actual beneficial entitlement to the property, and therefore income, etc., will be assessed in that way. What you tend to see is, especially with spouses, they will split it in accordance with what they think the beneficial entitlement is. So if you've got a typical situation where one party works, the other one doesn't, and they try and siphon off the income from the property to the non-working spouse, then without that election, the revenue can justifiably say, no, well, we want only half of that to be taxable on her, half of it to be taxable on the working spouse. So without that election, you can fall into some nasty tax traps.
But the others, both spouses need to have an element of title on the property, or can it be just in one spouse's name?
There has to be some kind of element of interest. Well, it doesn't necessarily need to be a legally registered interest. Something like an intention or a declaration of trust can apply. And obviously, if you get to the point where you have more than, and if it's outside of a spousal relationship, You can have more than 4 owners. You can only show 4 on land registry. So if you've got multiple parties, then you can have agreements which show who is entitled to what.
Okay, good stuff. Thank you.
So moving on to stamp duty land tax. SDLT is a nasty tax. It's payable by the purchaser in a land transaction. It also includes a simple conveyance of land, such as buying a house, and also creating or assigning a lease. It's payable by the purchaser in land transactions occurring in England and Northern Ireland. For transactions occurring outside in places like Scotland and Wales, they have their own separate transactional tax for land. Scotland is the land and buildings transaction tax, and Wales it's the land transaction tax. Each have separate and slightly different rules governing them and differing rates. For the purchase of additional properties that are not your main residence, there's also a 3% stamp duty surcharge that applies. So therefore, you look at the stamp duty tables and rates that are in force at the moment, and if it's not a main residence purchase, for instance, it's another buy-to-let acquisition, then you would add another 3% to each of the bands, the standard rate bands that are in the tables HMRC produce. So examples of those additional properties are holiday homes, buy-to-lets. It can also apply to a main residence if you haven't sold your existing main residence. So for example, going back to the chain example, if you're selling, if you've managed to buy your next home but you haven't quite sold the previous one, you pay the 3% up front, and then provided you sell within 3 years, you can reclaim the 3% that you've already paid. So it's an additional cost if you haven't got rid of your main residence or replaced your main residence.
But of course, you lose the PPR as well, don't you, if you have to wait 3 years?
If you have to wait 3 years, yeah, you start losing that 9-month bit at the end. So they catch you both ways, unfortunately. On top of the current rates that we've got for SDLT, there's an additional 2% surcharge for non-resident acquisitions. So those who buy property in the UK and are not resident for tax purposes, they will add the 3% and then the 2% on top. So for them, it's quite an expensive tax. And under the current stamp duty holiday we've just gone past the first period, which was from when the original restrictions and pandemic relief incentives were introduced to the end of June. We've now got a period from June to September where there's a gradual tapering of the nil rate band, and it will revert to the previous rates of 125,000 being the starting zero band from the 1st of October 21.
Great.
Annual tax on enveloped dwellings, or ATED, as we call it in the trade. It applies to an interest in a UK residential property which is owned by a non-human, i.e. a company, partnership, etc. So basically any kind of structure that or envelope type of ownership that's not in an individual name is potentially subject to ATED. The ATED return is a bit unusual in that it's filed at the beginning of the tax year rather than at the end of the tax year. And it initially only applied to dwellings worth over £2 million. This was reduced in April 15 to 1 million, and then the following year they decided to reduce it again to 500,000. So each property that a company owns or a partnership owns potentially over 500,000 should be filing ATED declarations. There is talk as well of them reducing that down further, and I've seen some comments about 250 being the starting limit. So obviously that's
generating some good revenues from it.
Yeah. We have some slightly unusual rules with regards to valuation dates. So when you have a property value for ATED purposes, it's fixed for 5 years, regardless of whether or not that property sort of appreciates in value. So the last valuation period was the 1st of April 2018. So in theory, if you already owned a property that was in a company, for instance, at that date, you've got another 5 years before you have to consider whether or not it breaches that 500,000 threshold. If it's clearly over, then you're obviously in the ATED regime. But if it's, say, 450, you've got a period of 5 years grace before you have to revalue. Any acquisitions that occur, say 1st of July, for instance, you would take the value at that date and whether or not that goes into the ATED regime. It's very much a case of file the return and claim an exemption if it so applies. So basically, if a property is used for rental purposes to unconnected parties, or if it's held as trading or development stock, you file the return and claim a relief from it. If you have an ability to occupy that property, or if somebody connected to you occupies that property, ATED charges can apply, and they're extremely high in terms of cost. And it goes on a sliding scale. Obviously, the more expensive the property, the higher the ATED charge. But
approximately, what are those charges? Phil?
So I think off the top of my head, the starting charge is £3,700 and something per annum for a property that's about 500,000 to, I believe it's 2.5 million, and then it goes up and up and up. And some of the costs can be over sort of 50k a year, depending on if they're really high value property. And as I said, the return has to be filed to claim the exemption. There is no let out. So each property over £500,000 in value must have a return filed connected to it. And it's one that often gets overlooked. The penalties can be quite harsh. I've seen a client have a penalty for £3,000 for an extended failure to file a return. So it is worth bearing in mind if you've got property that fall within that criteria, or if you need to, if you're acquiring a property that may fall within the regime. Moving on to the next slide, which is for non-resident landlords. So if you let residential or commercial property in the UK and live abroad for 6 months or more each year, you're classed as a non-resident landlord, even if you are a UK resident for tax purposes. And if you're classed as a non-resident landlord, there are some special provisions that apply. You have to effectively get HMRC's approval to be taxable under the non-resident landlord scheme, which effectively allows for the rental income to be paid gross, i.e. no deduction of tax. If you have a separate reference number from your normal tax reference numbers, so a non-resident landlord scheme reference number will be issued to you. That will be passed over to your letting agent if you have one, or your tenant if you have one, because if you don't have that gross payment reference status, in theory, the letting agent or the tenant should be deducting basic rate tax from the rental income you receive. They are required to pay it over every quarter. So if you have a client, for instance, that is based outside the UK, they rent a property in the UK, and you don't see this non-resident landlord's scheme number, you are legally required to deduct basic rate tax from the rental income. Individual landlords who are non-resident may still be entitled to UK personal allowances, which can be used against letting income. The main categories that are entitled to the allowances are British and economic area citizens, although now that we have left the EU, there is talk that may be actually rescinded, and the allowance only becomes available to resident UK citizens. If you are not resident in the UK and dispose of any UK property, you must report the disposal to HMRC within 30 days, as we've mentioned before, of conveyance of the property, and pay any tax due within this date. Interestingly, this also applies to gifts as well. So a common misconception is where a property is gifted to someone, there is no tax to pay because you didn't receive anything from it. That's not technically the case if the person is connected to you. So most common examples are close relatives such as brothers, sisters, parents, siblings, children, etc. We substitute nil consideration for market value consideration. So if you have a buy-to-let property that's sitting on a market value of £1 million, and you gift that to your children, you are chargeable on £1 million worth of proceeds, regardless of whether or not you receive a penny from them. So it is something that catches people out quite often. If a gift is made, and obviously being UK real estate, it falls within the gifting provisions for inheritance tax in the UK, because it's a UK situs asset, and that is now regardless of whether the non-resident landlord or UK landlord hold it through an entity or hold it in their individual names. What used to happen, especially for non-resident landlords years ago, was that they would set up a structure and the underlying asset would be outside of the scope for inheritance tax and capital gains tax because you own the shares in a property company. That's now not the case. We have look-through provisions, and therefore every owner of UK residential property will be subject to CGT and potential inheritance tax. Next slide. So we also have a slight departure from the way that corporate non-resident landlords used to be taxed. Historically, they were bizarrely taxed under income tax rules, which never really made sense to me. But from April 2020, they are now taxable under corporate tax rules, meaning they are obliged to file a corporate tax return rather than the old income tax return. They have to provide a tax computation as well as some kind of accounting information, which is something that is new. It basically makes them fall in line with UK resident property companies. Under the new rules, the non-resident company is chargeable to corporate tax on its profits from the UK property and also potentially on profits from loan relationships or derivatives that enable the company to generate the property income, i.e. if for some reason there is some kind of loan arrangement that generates interest relating to that property, they are taxable on that in the UK as well. So we now have a system whereby we've moved from one type of tax to the other. You would hope that HMRC would have done a lot of the legwork for you, but unfortunately that's not the case. We now have to re-register. The initial idea was that HMRC would generate the taxpayer reference numbers for the companies and rescind the previous income tax reference numbers, but in practice that hasn't worked across the board. We have many clients that haven't received their corporate tax reference number, and we're now in a position where we're trying to follow up with HMRC to obtain that, because obviously we can't file anything without that ETR. We also have to apply for agent reference because they're not transferring the records over, and as a result it's creating a lot more headache and hassle. HMRC have got a backlog of work, so it's a real pain for advisors at the moment trying to get their clients compliant with the new regime. And furthermore, you've got increased compliance costs because of the fact that you now have to prepare accounts and computations, whereas before it was just a simple tax return. So we're actually experiencing quite a few clients considering onshoring offshore property companies, i.e. transferring the ownership from somewhere like a Jersey or a BVI to the UK, so that it makes, you're not doubling up on fees and it makes life a lot easier. Moving on to MTD for income tax. Landlords now, or coming up shortly, I should say, in April 23, will now have to comply with making tax digital. So landlords and self-employed businesses as well, with annual business or property income of above £10,000 will have to comply with the new programme. Under the new rules, landlords will have to submit financial updates every quarter and provide an end-of-year report declaring any reliefs or allowances. This is the next big step in the government's attempt to take the tax system online. We've already seen, this happen with VAT. It will be happening with income tax across the board and corporate tax in the slightly further future. HMRC interestingly stipulate that taxpayers within the scope of MTD must use functional compatible software to meet the new requirements. And these compatible software programs, i.e. that have to connect with HMRC system via something called an application programming interface, or API. The software functionality must include the ability to keep records in a digital format, preserving digital records in a digital form, creating a tax return from those digital records, providing HMRC with tax data voluntarily, which I'll just touch on briefly, because it means that if you incur, for instance, a significant amount of expenditure, you will then have to upload that data to HMRC rather than them asking you via a tax inquiry, which is how the current system plays out. It also means that making year-end adjustments and making year-end estimations will be subject to a lot more scrutiny and potentially not as viable as they are at the moment. It also means that the software will be able to receive information from HMRC, so it's not a one-way street. And you'll be required to submit the records at least every 3 months, a quarter, as I mentioned before. The regulations specify information a business needs to keep and requires is to preserve these digital records for up to 6 years. Now, in theory, that shouldn't be a problem because of data storage, but it is worth bearing in mind that you would need to keep this because the HMRC still have their current tax investigation powers. So there are cloud accounting packages that you can use, such as Xero, Sage 1, QuickBooks, etc. And it will provide that real-time information. It's something that we are trying to press to the clients that it's an important topic to consider. You know, we're less than 2 years away now. And if you have a significant property business, you need to consider moving on to an online platform if you haven't already, because you know it's a mandatory requirement within that period of time. I think
Phil, we've got just a couple of quick slides that I think run through, but I've got 2 questions that I really would like to answer. One's for Simon and one's for Dilip. So
sure.
If we just skip through the last 2 slides because we have overrun.
Yeah, sure.
So just some brief things on our services.
Yeah, I mean, we can obviously help. We can. We're looking at a lot of property planning, particularly in terms of wealth preservation, as Salish mentioned before, IHT of 40%, property prices appreciating over time. They're always going to outstrip any increase in tax relief. So it's an area that is, you know, generating a lot of interest and a lot of work for us, and something that we are quite specialised in providing. And we also have a multilingual team, as it says at the bottom, which does help.
And these are just some other services that we either provide directly or in partnership with third parties. So some other areas that might be of interest to everyone. Thank you, Salish. Thank you, Phil. A couple of quick questions though that I've got in front of me from first one's from Simon. Pre-letting expenses. So if a commercial property is mortgaged, would those mortgage payments receive relief whilst the property is unlet?
So if it's whilst the property is available for let, then yes, they will. So if you've marketed the property and you're just unable to find a tenant, or there's been a replacement of a tenant, generally they are deductible because they're ongoing business costs.
Can I just add, that's only the interest element of the mortgage payment, the capital element.
Okay, and the next one's slightly more complicated from Dilip, and it may require obviously a follow-up because I think the answer is much more bespoke to the individual situation. But Dilip says he's seen mention of hybrid mixed partnerships. What are these, and how are these efficient vehicles for asset transfer to the next generation?
Yes, it is quite a complex question. So hybrids are typically where you have some kind of corporate involvement at partnership level. So one of the partners is a corporate or another type of entity. They can be useful, but unfortunately they were abused quite a number of years ago, and we now have a raft of anti-avoidance legislation and mixed member partnership rules. So it's something we would probably need to take offline and look at the individual circumstances. As I said, they can be used, but you have to be extremely careful, because if not, they treat it, and if you don't, structure them in the correct way, they treat the income stream going to the company or gain stream going to the company as basically being taxable on the individual members of the partnership. So you do have to be very careful, and I'm happy to discuss offline if it helps.
Yeah, I thought that was going to be the answer. So Dylan, please do reach out to Phil, and I'm sure I'd be happy to have a brief call with you, give you a sense of how these might be effective for you and how we can help. I think that's obviously we've overrun quite a bit, so great. Thank you for the questions. If there are any other ones, please do feel free to ping an email across to your relationship at McAlvin's and/or Salish, Phil, or myself. Thank you very much for joining. I hope you found the session of value. We're always happy to have a quick chat to get a picture of things. So, as I said, do reach out and we can have those sort of preliminary conversations. And whilst the football didn't come home, I hope you enjoy your home this weekend. The weather looks fantastic. And no doubt this Sunday will be a much brighter day than the last one. So thank you very much and hope you have a good rest of your days.